When it comes to stock investing, and more specifically the world of stocks that pay dividends, one of the confusions that comes up is the difference between a stock split versus a stock dividend. In this video, I'm going to share with you the difference between these two different terms, and also most importantly what it means for you as an investor when a company issues a stock split versus a stock dividend. And if you stay until the end of the video, I'm going to share with you different ways that you can use to be able to track dividend payments on your spreadsheet. Okay, so to start this discussion of stock splits and stock dividends, I've added this little graphic that you can read right here. But really what I want to do is I want to walk you just briefly by the definition of a stock dividend and a stock split, so you begin to understand the difference between these two different terms. And most importantly, what I want to do is share with you some practical examples of different stocks and what would happen to their financial position if they issued a stock dividend versus a stock split. So to start off, we have stock dividends, and stock dividends is basically a way for companies to reward investors for investing in the company and holding on to that stock in the first place. So you've invested into Apple, for example, or Coca-Cola, or whatever company that pays dividends, and what the company does is that out of its profits or cash flow, the company distributes a percentage of that money, or even all of it if they want, and they share it with the investors. So that way the investors are happy that they're getting some cash back from their investment, and perhaps they're a little bit more willing to invest in the stock in the first place. So that is the definition of a stock dividend. On the other hand, we have stock splits, and stock splits are different in the sense that a company has so many shares that are issued that investors can buy, and so a stock split is essentially a way to add even more shares out in the market that investors can buy, so that way the company can first of all get some money from the issuance of those shares that investors buy. But most importantly, usually the objective is that if the company's stock price per share is too high, so let's say the price per share is like $2,000 for one single share, the reality is that most investors cannot afford, even if they want to invest in that company, to pay $2,000 for a single share. So what companies often do is they're like, okay, we're just going to issue a lot more shares, so that way we can take the stock price from $2,000 per share to maybe $1,000 per share, and that is going to attract a lot more people to invest in this particular stock because it is a lot more affordable on a per share basis. So now you know the difference between these two different terms. Okay, so as you can see, we have a list of stocks. In this case, they're all semiconductor stocks, and we also have their free cash flow. In this number we basically got from Y-Sheets, an add-on that you can use on Excel and Google Sheets to get stock data right on your spreadsheet. And so we use these formulas to be able to retrieve, in this case, the free cash flow for each of these companies right here. And the free cash flow is essentially the money that the company has to be able to spend in terms of paying back shareholders, in terms of new investments, whatever the company wants to do. This is the real money that they can use to invest in different things. So what we're going to do is we're going to pretend that each of these companies want to start paying a dividend or increase their dividend payments to shareholders, and we're going to see the end result in terms of the cash flow left that these companies would have if they were to do that under different scenarios. So the first thing that we're going to need is to get the company's shares outstanding, so that way we can see how many shares are outstanding for each of these companies. So we're going to use the WSPress function for that. Select this list of symbols, and then what we're looking for is the shares outstanding, so we're just going to select this. And just like that, you're going to be able to get the real-time number of shares outstanding for each of these companies. Now we're just going to make up a random number for each company. Let's say that each company wants to pay $1 per share. That's how much they want to pay. So we have $1, and all companies are going to pay that $1. Now, what does that mean? That means that the total dividend, so I'm just going to add a column here. The total amount of dividends that a company is going to pay is just going to be equal to the payment per share that they want to make times the number of shares outstanding. So we do this for this company, and now we can simply drag it down for all these other companies right here. And this is the amount of cash that they would have to pay all together to all of their shareholders in order to have a $1 dividend per share increase, or even an issuance, because maybe some of these companies are not paying dividends right now. Now the ending cash would be the free cash flow minus the total amount of dividends that they've decided to pay. So as you can see, in this case, TSM would be left with this amount of cash, which seems like a lot, but you can see this number changes for all the different companies. In this case, if Intel decides to pay this much in dividends increase, they would actually have a negative cash. So we probably don't want to do that, because that means they would be losing money essentially by issuing this dividend. But I hope that with this example, you now have a more concrete understanding on how it is that companies issue dividends to their dividend investors. Okay, so now for the other side of the coin, we have the stock split. So in this case, what we're gonna do is we have the same list of stocks. We also have the current price per share and the number of shares outstanding. So what we're gonna do is we're going to refresh this information. So I'm gonna go here on this cell that has the wise price function, click enter, and right away the data will update. So now what we're gonna do is, with this table, you will get a much better idea of what happens when a stock split does take place. So in this case, we have the price, the shares outstanding. So the total value of the market, or the market capitalization of the company, is very simple to calculate once you have these values. So you take the price per share times the number of shares outstanding, and this gives you essentially the market cap for all these different companies out here. We can click here to get the number for all the different companies that you can see, and this is currently the market capitalization of these companies. Now let's say that each of these companies decides to do a stock split, and the type of stock split is a 2-for-1 stock split. And that basically means that for existing shareholders, if you hold one share, that share will transfer to 2 shares. So you were 1 share before, but now you have 2 shares. So essentially what would happen is that you would double the number of shares outstanding. So this would be times 2, and this would be the new number of shares outstanding. And because you double the number of shares outstanding, naturally what's going to happen is that the price is going to decrease by half. So you take the current stock price divided by 2. And the reason why that happens is that you basically, because you're multiplying by 2, you're basically going to divide the price in half, or multiply it by 50%. So the new price per share is going to be half of what it was before, naturally. Sometimes because the market reacts well to the stock split, it could be a little bit higher, because now all of a sudden, instead of a share being, for example, $739, now it's $369, which is a lot more affordable for more people. Then this may increase and go to, like, let's say $371. So you may have a potential gain there, but the general principle, you have the stock price when you do a 2-for-1 stock split. You can also do a 3-for-1, 4-for-1. I mean, the possibilities are endless, right? But then the interesting thing here is that you can then take the new price, multiply it by the new number of shares outstanding, and you will see that overall the total value would be exactly the same as it was before. So you can see the numbers are the same. The only difference is that now there's more shares outstanding, but the stock price did go down, which is okay, because that's usually the purpose of stock splits, to be able to lower the stock price so that more people can afford the stock. After that, you can do the same calculation for all the different companies, and then you're done with this process. So now you can better understand how a stock split works. I just want to share with you how it is that you can get some very important information, such as the dividend yield and the last dividend payment. So we're going to add this to our graph, and you can also add a whole bunch of other metrics and dividend information. I just want to share with you these two because these are of course very important. The way that you do that is very simple. You just use the WISE function, select the symbol. We're looking for the dividend yield, which is right here. So we're going to lock this cell in, and then the period, I recommend that you use TTM for the dividend yield, and this is because it takes the latest stock price and the latest dividend payments made to calculate the dividend yield. After you do this, you can turn this into a percentage, and then you can use this for this formula for all these different companies right here, and this will tell you their dividend yield in real time. And for the last dividend payment, you can do something very similar. So in this case, symbol, the parameter is going to be dividend. And then for the period, we're going to use LQ. And LQ for dividends essentially returns the last dividend payment made. So this would be the last dividend payment made by TSM. And once you have the formula correctly set up, you can just simply double click here or drag it down, so that way you can get it for all the different companies. Now you know the difference between a stock split versus a stock dividend. So I hope that you found this video helpful and that you use this information so that you can make good investment decisions for yourself and for those people that you most care about. If you've enjoyed this video, make sure to subscribe and turn on the notification zone so that way you get notified every time we release a new video like this that's gonna allow you to take your investing game to the next level. I'll see you in the next one.